So on this lesson, I want to show you guys how I actually trade in a way that I have never seen. I've learned so much about order flow in the past 10 years since I started trading. And this is the only way that have made me profitable on the long term and consistently profitable, actually, on the NQ. I only trade NQ, okay? I only trade NQ futures. So, first, so to begin with, we can start off by realizing one thing, by observing one thing, which is I'm going to doodle here. Just don't pay attention to my doodling skills, to my drawing skills, because I'm really bad at it. But the first thing is that the first approach that people have when they start trading is this, which is you know candlesticks, right? They learn about candlesticks. They learn about sharp patterns. They learn about technical indicators. They plot some moving average to the chart. Some Bollinger Bands and stuff like that. And although that might seem like a rocket science at first, after a time that you actually learn it, right? You take the time to actually learn it, you realize that it's actually very easy, right? Because you just pay attention to candlestick patterns, for example, the hammer candlestick patterns, and you expect a move like this, and then the price rising right after that, and giving you a buy signal. So I guess we have all been there, and it turns out that the problem with this is that I'm going to be very frank here and really straight to the point. The problem with this is that the price, the future price, is not a result of past price. So what most people expect is that, oh, price gets to a certain area, price is doing this, and then it do this, and then people expect to draw a line on this price or expect to see a candlestick pattern on this region and the price to fall, given that a short signal. But if the markets were that easy, honestly, you wouldn't see this extremely high failure rate, right? You see people draw lines all the time on their charts. Like they draw lines here, they draw like, oh, I'm gonna draw a resistance line. Okay, then price, falls, and then now I'm gonna do, let's say, I'm gonna draw support line, okay, support region. Then they do this, and they expect the price to get to these such regions and make their trades, which seems very reasonable. But the problem is past price past price is not a reflection of future price. Okay. So what you're using to predict the price is the price. And that honestly doesn't make sense. And not only that, but many of you guys not only do that, but you actually use very lagging indicators. So not only you use like the candlestick patterns and stuff, but you actually use parabolic SAR, you use Bollinger Bands, you use exponential moving average serves a purpose, but it's not usually. I very rarely see someone using an exponential moving average as a trading signal, which honestly for me that will be just insane. But the thing is, some of you guys even use like parabolic SAR, high low. I've seen all of those indicators. I've seen all of those, and I would like you to be honest with yourself. Do you think that if you went to any institutional trader, dashboard to the desk, and you looked up at their screen and answer that with honesty, do you think that you would see any technical indicator on their chart? Or even if they're using a chart, like if they're using a chart to begin with, do you think you would see like parabolic SAR on their chart? No, I don't think so. I don't think so. They use very, very advanced technological tools, very high end tools. And well, they are doing that because they know that the market is not that simple in the way that, the market is effectively like essentially simple, but the way they use in order to predict the price, of course, it requires like tools that you don't need because they need to, to dissolve their positions because their position is way too big and stuff like that. So they have issues, they have problems that you don't have to worry about. What you have to worry about is just catching a little bit, like you catch just micro inefficiencies. Just let me draw this correctly. You want micro inefficiencies because those are the moments where the discrepancy between risk versus reward becomes really clear. It becomes clear. It becomes like night and day. It's just something that you can observe and you can take the trade with a very good risk to reward ratio. And those moments, they're not observable. They're not observable by just looking at the price. Okay, you cannot observe those by just looking at the price. The price itself is not going to give you those signals, guys. I'm telling you, it's not just like in terms of signal, but in terms of context and stuff like that. The price, of course, it serves like a purpose. Like, I mean, you observe the price as a way to get ready to some kind of position, to get ready to some kind of either you have a more context on shorting or longing, going long, but it doesn't give you the signal itself. Okay, you might have some levels here, levels there, but looking at candlestick patterns or just like chart patterns, you see you see a movement happening, right? And what you decide to do is just like I don't know, you see a triangle, for example, right? Or you see a falling edge. You see a falling edge. And then you draw a line here, you draw a line underneath it, and you expect price to break through. But honestly, if it was that easy, to make money all just by drawing on the chart, like drawing trend lines, you draw the trend lines, you draw triangles and expect the price to break out of that. If you could actually make money consistently on a consistent, basis out of that, I mean, half of the people who try trading, they will be rich already because you're not stupid, right? I mean, most of the people they actually take the time to learn. Of course, there's just a few people who flip a coin and they expect the market to just like go into their direction. But most of the people they take the time to actually learn what they're doing. But the problem is the approach that they're learning doesn't work. This thing doesn't work. Looking at the price itself to predict future price is insanity. It's crazy, especially nowadays. Okay, especially when we're talking about the NQ or when we're talking about you know the ES or we're talking about I don't know the GC or the CL. All these futures contracts, they require a different approach. They require some kind of analysis that most of you are not looking at, and that is, of course, it's volume. We're talking about volume, but we're not talking about the volume, in the way that very simplistic approach that everybody knows, like the volume that you see right at the bottom of the chart, bottom like volume candles like this, right? This kind of approach. We're not talking about that either. We're talking about a way better and way more advanced approach of volume, and it's not footprint either. Footprint. You see the bids here. You see like the bids versus. Let me draw a candle here. You see the bid versus the ask, right? On a footprint chart. So you see, it's going to plot like this, right? That's a volume profile. I mean, a footprint chart, right? It's going to plot like this. And then two, or like I don't know if you have seen this, but on this side is going to plot the bid. How much was registered on the bid size on the bid side, and on the side would be the ask. So you would logically calculate, oh, so the bid is higher than the ask, therefore the market is going upwards, right? This might be a buying signal, but also that approach is very old fashioned. It's very old fashioned, right? What will require you to actually uh, be not on par with what the institutions do, because they have advanced tools that is not even available to the retail traders, right? But you would require something that registers the trades, register the aggressions in a much faster way, that registers, register something that most of you guys have heard about, which is iceberg orders. Okay, you need something that registers that plots to you, iceberg orders. And some people, they don't even go that far. They actually try to trade by looking at something called the the level two, right? Some of you guys have tried to, trade by looking at the level two, full of numbers and stuff like that, and the ticker, the times and trades ticker, which honestly to me is just something that you would do 100 years ago. It's simply impossible to. I mean, I've tried doing that in the beginning of my journey, and it simply did not work at all. So my point with this is, I'm going to be brief. I'm going to end this lesson for now. The past price is not the future price. Actually, the oncoming price is not a result. Is not a result of past price. Okay, is not a result. These two things, they are they are different. Okay, and if you look at solely at past price to predict future price, guess what? You're probably going to be break even. You're going to reach break even. That's the reason why I always try different strategies and stuff. And you think that sometimes it's working, sometimes it's not working, because it's going to lead you to break even. You don't really have an edge. I'm sorry to break it to you, but you don't actually have an edge, especially if you're trading some markets that don't even, that are just decentralized, like Forex market. You know, FX, honestly, you see so many trading gurus trying to sell you an image, of FX, like FX trading. They're trading like Euro, USD, and they place a trade. They place a trade here, for example. They place a trade here. They place a trade here with this tiny risk, and they grab this much of reward, right? This is their reward. You see them doing that all the time, but that is just illogical. That is just insane to believe in such, fallacies. To believe in such promises. You see, like 18 years old guys promising you all of that. Trust me, the hedge funds, the institutional traders, they don't use. Some of them barely use charts. Some of them barely look at charts. They only look at charts, to have the context of how much the price has moved. They're gonna look and see, oh, the price has gone up. They're not going to start drawing lines. They're not going to start, trying to predict the moves, trying to draw trend lines in order to see when the price is going to break through. That will be just insane. If you get to any institutional trader, if you talk to any, hedge hedge fund, manager or anything like that, if you talk to them, ask them about their knowledge when it comes to price action, when it comes to technical analysis and stuff like that, it's close to none, right? They don't know any stuff about that, but they do know a lot about order flow. They do know. I mean, if they didn't know about order flow, then they wouldn't have to develop so many tools and so many strategies to get past. I mean, to get past the eyes of everyone, or the eyes of their enemies, the eyes of their adversaries, right? Because what they're fighting for is for liquidity. They want to buy. They want to buy. I mean, if they want to take the price higher, they need to first accumulate, right? And then they're going to start distributing. That is something that is just uh, the basic concept of the Wyckoff theory, right? So accumulation and distribution. We can look forward more into that later on other videos. I'm not going to get way too deep into this, but the market, it has to accumulate and then distribute. These kind of movements, they only happen when the market is distributing. It's essentially distributing. They're essentially buying. People who sold here, they are actually, placing their stop loss orders are getting triggered. So it's something that triggers the market higher. And essentially the same thing happens, inversely, when the market's, collapsing like this. And these are the moments where you can catch very good trades with very high risk to reward ratio. But it doesn't simply happen by looking at the chart itself, like, oh, the price is doing this, and then out of nowhere, I'm gonna draw a line here, and once the price breaks through, I'm gonna take an entry, and boom, I'm gonna take an entry short here, and this is how much I'm gonna take as reward. It doesn't work that way because you get so many false signals. You get so many false signals, fake entries, all the time. So the price is doing this, you expect the price to break through, and I mean, you take an entry short here, you get stopped out. You take an entry long here, you get stopped out. You take another entry short over here, and you get stopped out. So that is essentially the reason why I don't like to use price as something to predict the future price. I mean, I might look at it only for the context, but I'm not draw lines, support and resistance lines all the time, and try to predict what is going to happen by looking at this thing. Hell no. That's not the way it happens. So on future videos, I'm going to give you guys an approach, that I use that helps me make, on average, $2 to $4 to $5,000 a day on the NQ, and I'm going to show you my performance reports to prove you that. And it's the only way I found on how to do it. It's the only way I found on on especially on the futures market that allowed me to build a consistency, along the time. So I hope this video was helpful. Leave a like button, subscribe to the channel because we're gonna have lots of content in the future, in the near future about this. Okay, peace and out.